Welcome to the AI Research Roundup. I'm Alex. Today we're looking at a paper trending on X, published on March 2nd, 2026, about 4 days ago. It evaluates modern deep learning architectures on highly noisy financial data, finding that a hybrid model combining variable selection networks and long short-term memory achieves the best risk-adjusted performance, hitting an impressive Sharpe ratio of 2.4. The paper is titled Deep Learning for Financial Time Series, a large-scale benchmark of risk-adjusted performance. And as we will see later, the results have significant implications for balancing raw returns with downside risk in real-world trading. Alright, Figure 1 maps out the end-to-end portfolio optimization pipeline. It starts by taking raw time series data and extracting statistical and technical indicators. These features are then fed into one of several supported models, ranging from recurrent networks like long short-term memory to state space models like Mamba. The network's output is subsequently transformed into portfolio weights using a linear projection and a hyperbolic tangent activation, which keeps the position sizes bounded. Finally, rather than minimizing standard prediction errors, the pipeline is trained to directly minimize the negative Sharpe ratio, ensuring the model learns to balance expected returns against risk. So after establishing the training pipeline, Table 1 breaks down the out-of-sample Sharpe ratios across different time periods. The variable selection network and long short-term memory hybrid consistently leads, achieving a remarkable Sharpe ratio of 2.4 for the full 2010 to 2025 stretch. Another strong performer is the long short-term memory and patch TST hybrid, which actually edges out the first model during the volatile 2020 to 2025 period. Meanwhile, pure linear baselines and generic state space models show much lower and more volatile returns, emphasizing that adaptive gating is crucial for unpredictable markets. Okay, while the previous table highlighted specific out-of-sample periods, Table 2 dives deeper into the full sample gross return performance and statistical significance from 2010 to 2025. Here, the variable selection network and long short-term memory hybrid clearly stands out, delivering a compound annual growth rate of about 26% and a top Sharpe ratio of 2.39. We also see an interesting contrast with pure attention models. The iTransformer, for instance, exhibits extremely low turnover, which means it rarely updates its portfolio positions, but this conservative approach results in a weak Sharpe ratio of just 0.35. Ultimately, this data reinforces that the most effective models must balance adaptive responsiveness with controlled trading intensity. Well, following the detailed breakdown in the previous table, Figure 2 visually corroborates those findings with cumulative gross profit and loss trajectories. The leading sequence-based models, especially the hybrid combining a variable selection network and a long short-term memory network, clearly dominate the top of the chart. These models maintain relatively smooth upward paths over the entire timeline, which indicates that their high Sharpe ratios come from persistent, incremental returns rather than just a few lucky trades. In contrast, standard architectures like a plain long short-term memory or patch TST experience much larger drawdowns along the way, highlighting their greater sensitivity to extreme market movements. Alright, picking up on those drawdowns, Table 3 quantifies the downside risk and tail behavior across the evaluated models. The variable selection network and xLSTM hybrid excels in risk mitigation, recording the smallest maximum drawdown of about minus 12%. It also achieves the highest CalMAR ratio at 1.64, which is a metric that compares average return to maximum downside, indicating strong capital protection. Meanwhile, the long short-term memory and patch TST hybrid demonstrates superior resilience as well, leading the pack in both the minimum annual Sharpe ratio and 5% conditional value at risk. Okay, while the previous table detailed downside risk, Table 5 shifts focus to computational efficiency by comparing parameter counts and memory complexities. While simple linear models require the least compute, their earlier performance was quite weak. Instead, the variable selection network and long short-term memory hybrid stands out again, achieving strong returns while maintaining linear memory complexity. Unlike generic transformers that suffer from quadratic memory growth as sequences get longer, this recurrent hybrid avoids those expensive attention costs. Ultimately, these comparisons show that raw computational efficiency alone does not guarantee economic success, and careful architectural design is crucial. Wrapping up, 2 takeaways stand out. Hybrid architectures with variable selection and adaptive gating are essential for handling noisy financial data, easily beating standard attention models. Furthermore, real-world trading success requires balancing those raw returns with strict drawdown control. That's it for this episode of the AI Research Roundup. I'm Alex. Thanks for listening.